Problem 18-29. We're going to create a schedule of cost of goods manufactured, and then we're going to create an income statement. Gourmet Bones manufactures its own brand of pet chew bones, so we make pet chew bones. At the end of December 2024, the accounting record showed the following. So we got a couple data tables. Requirement 1, prepare a schedule of costs of goods manufactured for Gourmet Bones for the year ended December 31st, 2024. For accounts with a zero balance, make sure to enter 0. All right. So our cost of goods manufactured, we need to calculate this number over here. And why? So we can calculate the cost of goods sold, which uses cost of goods manufactured. Why do we need to calculate cost of goods sold? Because we need to do the income statement. So we have to do the schedule of cost of goods manufactured first. So we're going to start with beginning work in process inventory. So work in process inventory began with 0. How do I know that? I'm getting it from here. Beginning, ending, 0. Beginning work in process inventory. Next, it says we need our direct materials used. And the direct materials gives us a beginning and an ending, and this window does not tell us direct materials used, it tells us direct materials purchased. Okay, so we have to go back and do this calculation, which calculates direct materials used. So we start with beginning inventory of materials. So beginning direct materials, we get that from right here, 13,500, copy, paste. Next, we have our purchases and any freight in other words, some delivery expenses to bring it, some shipping expenses, I should say, to bring it to us. Now that's not on here, so we open up the next window. And we've got purchases of direct materials. Direct material purchases right here, 36,000. Purchases of direct materials. Now notice it says freight in. That means any shipping costs to get the items to us. So don't get that confused with delivery costs. Delivery costs are our costs to deliver our finished chew bones to the stores. So we're not going to include this. So we're going to take the beginning materials, add the purchases, and that gives us direct materials available for use. Direct materials available for use. So 13,500 plus 36,000 gives us 49,500. So we have direct materials available for use of 49,500. We then subtract our ending direct materials, which we get from right here. Ending is 7,500. Ending direct materials. So we had 49,500 available. At the end of the year, we had only 7,500 left. Therefore, we must have used the difference. So 49,500 minus 7,500 gives us direct materials used of 42,000. So that gives us this number here. Then we're going to plug it back in over here under beginning inventory. So we've got a beginning inventory of WIP right up here. And we've added our direct materials used. So next we need our direct labor. Direct labor is not on here. Let me open up the other window. Direct labor is right here. So 23,000. I'm going to copy and paste that. Direct labor, where's that at? Right there. Okay, then we're trying to calculate total manufacturing overhead. So let me close this. This does not have manufacturing overhead in it. Okay, so we have to go through here and see which one of these are manufacturing overhead. Let's start here. Direct materials, we've already used that. Plant janitorial services. So this $700 is part of the manufacturing process because it's the janitorial services for our plant. Plant janitorial services. All right. Sales salaries. These salespeople do not build the product, therefore this is not a product cost and therefore not manufacturing overhead. Delivery, that's for when we deliver the product, so that's part of selling. Revenue obviously is not this. Utilities for the plant. So because these are for the plant, we need to include this in manufacturing overhead. Utilities for the plant. Let's see what else we got. Rent on the plant, $17,000. Copy and paste. Now if this was rent on the headquarters where they don't manufacture it, or on the sales buildings, and that's not included in manufacturing overhead. So then we're going to add these up. 700 plus 1,300 gives us 2,000 plus 17,000 gives us 19,000 of total manufacturing overhead. So we've got beginning up here, direct materials right here, direct labor right here, and then manufacturing right here. We're going to add these up, and that gives us total, excuse me, right there, let's click correctly, total manufacturing, oops, I'm sorry, total manufacturing costs incurred for the year. So 0 plus 42,000 plus 23,000 plus 19,000 gives us 84,000. So that gives us total manufacturing costs to account for. Next, we're going to subtract our ending work in process. So we need this first one. Here's work in process ending, 3,500. Copy and paste that. Oops, I messed up. Sorry. This goes down here, 3,500. So let me back up because I showed this incorrectly. All right, so total manufacturing costs incurred for the year are 42,000 direct materials, direct labor, and then total manufacturing overhead. That gives us 84,000. Then we take the 84,000, which is manufacturing costs incurred during the year. Then we add them to the beginning, and that gives us the total manufacturing cost to account for, which is still 84,000. Copy, paste. I hope that's clear now. So these three, this, and this, direct materials, direct labor, manufacturing overhead gives us total manufacturing costs incurred during the year. Then we add in the work in process from the previous period and add that, and that gives us total manufacturing costs to account for. All right, which is this 20,000 over here. Then we subtract ending work in process. Ending work in process. Okay, so here's what we're going to do. We had all these to account for, 84,000 costs to account for. Then at the end of the period, we only had $3,500 of costs in the work in process inventory. Therefore, the amount shifted out, transferred out, is the difference, 80,000, 500. And you can kind of see that on the T account. So this 80,500 represents the costs transferred out, cost of goods manufactured. The beginning balance is right here. Direct materials is right here. Direct labor is right here. And manufacturing overhead is right here. And then we subtract the amount, we subtract ending balance, and the difference is the cost of finished goods transferred out. In other words, the work in process is finally done and transferred into finished goods. So we had $80,500 of goods that were transferred out of work in process because they were finished. Now we're going to work on the income statement. So for the income statement, we need this info here. So we're going to find revenue, net sales revenue, which is right here, 107,000. Cost of goods sold. So see this explanation of how we calculate cost of goods sold? That fits right in here. So the way we figure out cost of goods sold is we take beginning inventory of finished goods, beginning finished goods inventory, which was right here, 0. Oops, 0. Then we're going to find cost of goods manufactured, which we're going to copy from here, 80,500. So we had 0 at the beginning, 0 finished goods at the beginning. We had $80,000 80,500 manufactured this period and transferred into finished goods. That gives us, when you add those two, it gives us 80,500 available for sale. Cost of goods available for sale. So we had $80,500 of chews, these pet chew bones, available for sale. So that gives us cost of goods available for sale. Then we're going to subtract ending inventory of finished goods, which we get from here. So here's finished goods inventory. We grab the ending inventory, and that's called ending finished goods inventory. Okay, so the way this works is, let me close this. We had $80,500 of pet chew bones available for sale. At the end of the period, in this case, end of the year, there were only 5,200 left. So why did it go from 80,500 down to 5,200? Because we must have sold the difference. So 80,500 minus 5,200 gives us cost of goods sold of 75,300. Damn comma. All right, which is this number here. So we've calculated cost of goods sold. So then we have revenue of 107,000. We subtract our cost of goods sold of 75,300, gives us gross profit of 31,700. Damn it, comma's getting me every time. Now we have our selling and administrative expenses. So these are the expenses that are not product costs. So let's see. Sales salaries would be one of them. I'm just working my way down here. Direct materials, that's a product cost. Plant janitorial, because it's a plant, that was a product cost. Sales salaries. So these salaries for our salespeople is a period cost, selling and admin. And this is sales salaries expense. Let's see what else we got. These delivery costs. This is a selling cost, so 1,300. Delivery. And let's see here, customer service hotline costs. That is not a product cost. That's for maintaining our product, our warranty and stuff like that. So that is called customer service hotline expense. There we go. So our total selling and administrative expenses we get by taking 6,000 plus 1,300 plus 1,200 gives us $8,500 of selling and administrative expenses. So we're going to take our gross profit, subtract our $8,500, gives us operating income, $23,200. Almost done. Requirement 3. How does the format of the income statement for gourmet bones differ from the income statement for a merchandiser? Well, a manufacturer's cost of goods sold is based on its cost of goods manufactured. So remember, here's the cost of goods sold calculation for a manufacturer. It's based on cost of goods manufactured. In contrast, a merchandiser's cost of goods sold is based on its merchandise purchases. So because a merchandiser just purchases their merchandise, they don't manufacture it. And one more thing to go. Gourmet Bones manufactured 17,900 units of its product in 2024. Compute the company's unit costs for the year, rounded to the nearest cent. So what they're asking us to do is to take the cost of goods manufactured. So of all the pet chew bones that we manufactured this year, they cost us $80,500. So we take the total cost to manufacture them, divided by the number that we made, gives us our cost per unit. So we're going to take this cost of goods manufactured, 80,500, 80500, divided by the number of units, 17,900. It's a lot of chew bones, 17,900 equals 4.497, and it says round to the nearest cent, which means round to the nearest 2 decimals. So that gives us 4.5 or 4.50. Same thing. And that's it. So it cost us $4.50 per pet chew bone to manufacture, which means we sure as heck better charge more than $4.50. Otherwise, we'll be operating at a loss. And we must have been charging a decent amount because we have operating income that is positive.